Alrighty, welcome everyone to February the 8th. We're going to be going over spread trading as well as the psychology of trading. I just wanted to spend a quick minute to go over with you. For those of you that don't know, you have purchased into the Safe Option Strategies education. If you have not gone through the recorded or a live orientation class, for those of you that do not know what this is the education that was purchased for you. To enter the site, you just go all the way over to the far right where it says members. You click on members. You have the complete Safe Option Strategies course, so if you click on that, it'll actually come up and ask you for a login and a password. Mine's already saved in here, so you have a login and a password. You enter those on in. And here's your education. You can start off at any level. We're going to finish up with level 2 today. So you could literally go to level 2 if you click on it, and all the level 2 classes are here for you to be able to see, for you literally to click on any of the pictures of the courses, and you can hear the owner, Jeffrey Dunyan of Safe Option Strategies, go through. You can also click on the accompanying PDF. It's what I've been sending out to you. Gives you the ability to have notes to have in place before the class starts. This is just a good way for you to hear the information again, hear it in a little different way of teaching than what I do. I'll be honest with you, I'm more of a doer than a teacher. Jeffrey's education will probably be a little more interesting than what I've been doing for you. But today, we're going to get off and running to an introduction to spreads. Now that you understand the 4 option instruments, we're going to get to work on applying them in a position that can start to make you money. So, wait for my computer to go. We want to see it as a full screen. And let's see it so you guys are able to see it. Of course, that doesn't help anyone out when it's black. Come on. Duplicate screen. Show it in a full size. But you know what, since no one's here, I probably don't need. That'll make all of this tons easier. All right, Jeff, how does that look for you? You able to see that completely? It looks good. Able to read it? Perfect. All right, here we go. Today we're going to go over the introduction to spread trades, and we're going to get into the psychology of trading. But as usual, as a disclaimer, the class is a production of Safe Option Strategies, and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for educational purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. Plain and simple, guys, what is a spread trade? A spread trade is using 2 or more options at the same time. Long call, long put, long call, short call, long put, short put. Plain and simple, a spread trade is using 2 options to do one thing, Jeff, since you're here and I know Steve can't type in, I'm gonna push you a little bit today. Jeff, why might we spread trade? What's the advantage of spread trading? Using two options at the same time. And if you don't know, just type a couple question marks in. Protects your investment if it goes the wrong way. Bingo, Jeff, you nailed it. That's perfect. It gives you the ability to hedge. It literally, when you combine calls and puts, increases the odds or the probability of being profitable. It does so because you have two different positions that can make you money as the stock goes up, down, or sideways. That is the beauty of spread trading. There is a position that will make money no matter which way the stock market moves. The most common spread trades: a debit spread, where the money spent on the long option is greater than the credit taken in on the short option. A debit spread is literally, if you have a long call, you think, actually let's go a long put. You think the market's going to keep going down like it is today, down 370 points, right? You go ahead and you buy a long put, which gives you the right to sell. It plays the market on a bearish movement. And playing the market in a bearish movement, you place that short put below it. It lowers the cost of getting into your trade. It now gives you a position to trade that makes money if you are wrong. If it goes sideways or if it goes up, that short put, which is a bullish to stagnant trending position, makes money as the stock goes sideways and or up. A credit spread. A credit spread, by definition, is nothing more than that short option. That credit is greater than what you spend on the long option, resulting in a net credit for your trade. You sell to open a credit spread, you buy to close it, and the neat thing about a credit spread is the most you can make is that credit, but it makes money if it goes the direction that you want it to, or if it goes sideways. Again, it's increasing your odds to a 2 out of 3 way to make money, or a 66% chance of making money. Last but not, you can do a combination of trades where you use long calls with long puts, those are usually called strangles or straddles. You can do calendars where you're going to use different expiration months. There's a lot of different ways to mix and match your options, but for the most part, these are the most general ways or definitions to define your trade. If it's a debit trade, a credit trade, or it's called a combination trade. Combination trades are also going to be our collar trade, where you buy that stock, which is your bullish position. Your short call is your stagnant to bearish, and your long put is your bearish. Gives you some ways to make money, all three different ways that the positions are going. We have a chart of Starbucks right now. A very general explanation of a debit trade. Since Starbucks is trading at $58.65, and I'm going to go ahead, I'm going to get a pen that I can mark a couple things here. Since it's trading at $58.56, you think Starbucks is going to continue to go up. Man, that's my phone. I need to turn that off. I am sorry. I thought it was turned off. But here we go. We think Starbucks is going up. We buy the long call. For 52 days, we are buying the right to buy Starbucks at $60. It's going to cost us $1.48. Now, if we just played this directionally, we just want Starbucks to go up, we get a 1 out of 3 chance of being right, and we'll make money, on average, 33% of the time. Which means we would lose 67% of the time, just basic averages. For that reason, we go ahead and at the same time, we sell an option. We're going to sell a short call at a higher strike price than our long call. That's going to give us a 60-cent credit. Net, instead of having $1.48 at risk, 1 out of 3 chance, we literally have created a spread trade. Whereas we enter our trade, we are buying to open the long position. We are selling to open. That S in sell stands for short, right? We're selling to open the short position. The neat thing is, if we take a quick peek here, instead of spending $1.48 going directionally, $1.48 minus 63 or 60, this is called a spread in between here, we're going to get charged anywhere from 82 cents to 88 cents. We are lowering the cost basis of our long option, and we're now giving us a position where at least one position within the stock market makes money as your stock goes up, down, or sideways. Pretty common, pretty simple debit spread is that bull call spread. Buy to open the long call, you're selling to open the short call. The neat portion of it is you're going to spend less money on your trade, which equals less risk. You also have positions in play that can be adjusted because at least one position will be making you money. As you were to enter the trade, if we were to do this one on Starbucks, on 5 contracts, it would cost $450. Pretty simple way to enter a spread trade, and this is a debit trade. Jeff, any quick questions? Not that I'd expect you to understand this completely. Any quick questions on a debit spread? Buying to open the long, selling to open the short. It makes sense. You obviously will need some time to go over it, though. So what's the rest of the short, risk of the short call? Great question. Kevin, you said you never sell a short call, right? Because you're obligated to sell your stock at a certain price for a certain period of time. So, taking a look at this trade, I've got the right to buy. I've got the right to buy the stock at 60, and I'm obligated to sell it at 62. What's the risk of the short call? There's no risk. That short call is covered by the long call. You've got the right to buy the stock at a lower price than you're obligated to sell. The neat thing about a debit trade, the debit trade does not hold any margin. And the risk of any debit trade is the cost of your debit. Alrighty, let's continue to move on here. A credit spread. Remember, a credit spread is taking in a bigger credit than debit. And this, Jeff, is where you're going to get a little more risk. We're going to walk through a credit spread really quickly. Looking at the same chart on Starbucks. On Starbucks, we may choose to sell a put. If we're going to sell a put, well, we sell at the bid, right? We're buying at the ask. We're taking bids when we sell it. When we want to buy an option, we ask people if we can do that. Our credit would be $1.84. If we left this alone, we would be obligated to buy Starbucks at $57.50. As long as it trades above $57.50, we're going to be profitable. If it trades below it, kind of like our Disney trade, right, we'll be obligated to buy the stock at a higher price than it's currently trading at. But we go ahead and we take in $1.84 of credit. To create a spread using 2 options at the same time, we may choose to protect ourselves to the downside by buying a 5250 long put. That's going to cost us literally 68 cents. Two options. It's a credit spread. Going through the credit spread, the short, you're always selling to open the short. You're buying to open your long. As we come over here, when you're selling to open, over here on the right-hand side, right, this gives us our calculations on how much net credit we're going to get. In this particular case, buying the long, selling the short, it's going to give us $1.16 net of credit. Now, Jeff, I love the question you asked. Kevin, what's the risk? That's the way people should be thinking about their trades. Not how much are you going to make, but what's the risk? You've got $1.16. That's most likely going to be your net credit right there. You're obligated to buy the stock at $57.50. You have the right to sell it at $52.50. There's a $5 difference there. Your risk in the trade on any credit spread is the difference in two strike prices, $57.50 and $52.50, which is $5, minus your net credit is going to give you a risk of $3.84. Most you can make is your credit, $1.16. You literally have limited your risk in your trade. You know what your risk is to the dollar. For 52 days, your risk is going to be $3.84 times, we've got 5 contracts here, so times 500. And your maximum reward is about $580. There's a 3-to-1 risk to reward. Pretty decent for a credit spread. Jeff, so do you only do credit spreads to the low side of currently trading and debits to the high side of the currently trading? We're going to go over that, Jeff, but for a pretty standard rule of thumb, usually your debit spreads are slightly out of the money because you can pay less for them, and your credit spreads are slightly in the money for a better probability of being profitable. Why do you do a credit risk for a 3-to-1 risk to reward ratio? Really, anything 4-to-1 is deemed by historical averages pretty good. The short answer, though, Jeff, and this comes down to as we talked way at the beginning, when someone like me hears people talk about credit spreads and they want to get paid to pay to play in the stock market, they want to get paid. Yes, it's kind of foolish because you can make more money with less risk on Starbucks doing a debit trade than you can doing a credit spread. So the short answer really comes down to money, capital, margin, preferences. We're going to go over what debit trades are, how to place them. We're going to work through each one individually, but it really comes down to a personal preference, Jeff. And with all due respect, there's some people out there that are outright foolish that think a 25-to-1 risk-to-reward ratio is a good risk-to-reward ratio on broken wing butterflies or on iron condors. So the short answer comes down to there's some awfully foolish people in the stock market. I know that's hard to believe. All righty. Some of the names, we would not expect you to know any of these in all honesty. But bull call spreads, bear put spread, strangle straddles, collar spread, the covered call, the married puts, the calendar spreads. These are just general names. We're going to be teaching you each one of these one-on-one in the upcoming weeks. Credit spreads are usually the bear calls, the bull puts, the iron condors, the ratio back spreads. Again, we don't expect any of you to necessarily know these right now. These are the spreads that we're going to be teaching in the upcoming weeks. Couple helpful terms, and this is going to be just more stuff for you guys to learn. A calendar is any debit spread including strangles and straddles, or any debit spread using two options where the expirations are in different months. Kevin, I don't want to Kevin, I think a lot's going to change. So I'm not sure I want to lock me into a position for 3 months. I'm not sure in Starbucks I want to lock me in a position for 52 days. You can change the months that you have for expiration. That's typically called a calendar. A ratio, just like it sounds. More longs or shorts than shorts or longs. One of your contracts, usually it should be the long side, right? One of your contracts, you have more long positions than short positions. It's just called a ratio, just like it sounds. A vertical spread is just another name for a spread where both options are in the same month. And a horizontal spread is just another name for a calendar spread where the options are in the same strike price. Usually they're in different months. These are just some terminology that you'll want to spend a little time understanding as we go through levels 3, 4, and 5. We get into the trades or the spreads themselves to help you learn. Oh, diagonal spread, forgot it. A counter spread that uses different strikes and different months of options expiration. A little bit more for you guys to know just by way of terminology. Again, at this point, we would not have expected you to know any of these. For those that are more visual, a calendar spread has a long option in May and a short option in June. And the expectation is that that short option expires. When that short option expires, you're going to sell another one in February. When that one expires, you'll sell another one in March. When that one expires, you'll sell another one in April. A calendar spread is typically, as you can take a quick peek, typically where you would expect a stock to trade within a range, but obviously if it breaks out, you'll have a long option that can make money one way or the other. So typically a calendar spread is a stagnant trending trade. Calendar spreads, you can put it as a diagonal where you have that short option at a different strike price than your long option. That diagonal can be to the high side or to the low side. The neat thing about options, and I'm sure you guys are probably going, oh my gosh, Kevin, this is confusing. The neat thing about options, pun intended here, you've got a lot of options. There are a lot of things you can do to adjust or to trade according to the direction that the stock market's giving you. A visual explanation of ratio spreads. Twice as many long options against a short option. Nothing too spectacular about it. Anytime you're purchasing two long options, your expectation is that the stock has to move, and then it will move significantly. But here's a ratio spread with two long options against a short. It could be three long options. The ratio doesn't have to be 2 to 1. It can be 3 to 1. It could be 4 to 1. It could be 10 to 1 if you wanted to. But plain simple, a ratio spread just means nothing more than having more of one option than the other. A vertical spread, if you look at it thinking vertically, it just means one option is above the other. The bull put, that credit spread we were showing you, pretty common vertical spread, but it could be the long call. It could be a debit spread. All a vertical spread means is there's one option at a higher strike price than the other. Jeff, do the options and ratio spreads all the same strike price? They can, but they don't have to. For example, if I go back, the long options, because you're trying to make it cheaper, could be at 75, could be at 80, could be at 85, and could be at 90. All a ratio is saying is that you've got more of one option than the other. And that could be a 2-to-1 ratio. It could be a 3-to-1 ratio. It could be a 4-to-1 ratio. They do not have to be at the same strike prices. Again, we're just, today this is just generalities. Another great question though, Jeff. Thank you. Vertical spreads, one option is above the other. It could be intertwined. It could be a long above a short. It could be a short above a long. It's just saying it's vertical. They are debit and credit spreads. Horizontal spreads mean the same strike price but different months, just like the horizontal tells you. The longs or the shorts could be interchanged there as well. In general, a horizontal spread just means same strike prices, different months. Diagonal spreads. Now we're getting complicated, right? Think in generalities. Two options, different strike prices, and different months. Just think in terms of generals. You don't have to have these memorized. These are just general terms, and it's going to help you better understand through the next couple months as we go through individual trades. Why do we spread trade? Usually I'm going to give you 4 big reasons. It hedges the risk. We're spending less, so we have less money at risk. It helps us control our fear. We have a position that's making money no matter if the stock goes up, down, or sideways. It helps us control our greed. We can't lose all of our money because we haven't bet all of our money. And last but not least, again, controlling fear, it allows us the ability to adjust. Pretty simple class. I'm going to also go through what I found was pretty important. The psychology of trading. And as we finish this class, we will be done with all of level 1 and 2. This is the psychology of trading, part 1. In fact, before I start this, I'm going to go to our paper trading here. Taking a quick look. Good job, market. Our market this morning is down 300. S&P's down 33. NASDAQ's trying to push being down 100. So another crappy day in the stock market. Even though China is closed all week. Next Monday is President's Day. We will have the day off, so I will most likely be in here with you guys on Wednesday. But we have President's Day weekend. It's a short weekend. Excuse me, it's a long weekend. Short week of trading next week. China's closed this week, so we just see stocks tumbling like there's no tomorrow. Taking a quick look, way to go Apple. Apple's up 50 cents right now. Baidu's up 97 cents. Woohoo! With that said, Disney is tanking, down $2.73. Visa is tanking, down on $3.76. Sandus is down $1.50. Wow, Nvidia is down 3.5%. That's a big move, almost $1. A lot of big things are happening right now. Big moves on stocks. I guess the stock market did not like the fact that the Broncos won the Super Bowl. Keeve, I need you to make a quick call into the New York Stock Exchange if you don't mind. Someone may have told me that you'd be happy today with the Broncos winning, so go teach them to enjoy the winning team and enjoy what's going on. Taking another quick look, just as a heads up, Ford is actually up 7.5 cents. Facebook is getting crushed today, down another $3. Facebook has literally fallen $17 or lost about 16% in the last 3 days. Alibaba down to 61. It's lost 25%, down another $20.27. It's lost over 25% in the last 2 weeks. The XLF, the banking Spider 500 index, there's an ETF, down 55 cents. It also has lost 15% in the last week. Verizon down 50 cents. It actually has gained over 10% in the last week and a half. So pretty interesting. Taking a quick look at where we are at. And I see we've got a question here. Give me a quick second. Taking a quick peek at where we're at. We have the right to buy Disney at 100. Are we going to want to buy Disney at 100 when it's trading at $91.21? Well, we want to buy Disney at 100 when it's buying at $91.24. Jeff gives us a big no. You better believe it. Heck no, not a chance. We don't want to be buying it there. Which means we're going to have to adjust or fix this trade if it does not have some pretty good earnings coming up. Earnings for Disney are going to be on, let me find out for us here. It's either on the 9th or the 11th, so they will come in this week. We would expect fabulous earnings. It is on the 9th. So tomorrow after the market closes, we're going to see hopefully Disney pop right back up to 115. Out of curiosity, if it pops up back up to 115, what is going to happen to our short puts? Our short puts that are right now worth $9.35, something we sold at $3.88. What's going to happen to those short puts on Disney if Disney shoots all the way back up to 115? They'll be worth 15 bucks. Good guess though, Jeff. Go back to rights and responsibilities. Ooh, you know what, Jeff? I am sorry. No, it's a credit. Someone paid us and obligated us to buy the stock at $100. If it's trading at 115, is anyone going to want to sell the stock to us at 100? Is anyone going to want to sell the stock to us at 100? If it's trading at 115? Of course not, right? They'll say nope. I'm not selling you the stock at 100 because I'm going to sell it to someone else out on the stock market for 115. We're obligated to buy the stock at 100, which means this credit, since no one's going to want to sell it to us at 100, they can go sell it for $15 higher. That credit, that's going to go down to next to zero. It'll probably go down to like a nickel. In which case, the car we sold someone for $3.88, we get to buy back for a nickel. We'll capture $3.80 of profit after commissions. Why hasn't someone exercised the option then? Why not today, right? Why doesn't someone today, Jeff, say, you know what? You're stuck buying my shares of Disney. Great question. Well, the main reason is that's a long on the other side. Someone on the other side wants to protect their stock at $100. So, what are they protecting it from? Earnings. Earnings that's coming up tomorrow. Could someone exercise those puts against us and we get assigned the stock at $100 a share? Definitely. It could happen. But for the most part, people are expecting Disney to go higher. Think Disney's a great company. Think Disney just made the most profitable movie of all time and increased its earnings by $1.63 a share. So, for most people, it's a little hedge to protect their stock. If they have bad earnings Tuesday afternoon, you might see us assign those positions as early as Wednesday. But for right now, because there's so much uncertainty and there's the opportunity that it's still a great stock, expectation that it should go higher, no one wants to get rid of their stock at 100 until after that event of uncertainty comes to pass. And that's earnings that's going to happen, obviously, tomorrow afternoon. Jeff, does that answer your question? Thank you. All right, we've got long calls on Ford. Oh my gosh, Ford is sucking rocks. The good news is we have this all the way out to when? When do we have to see Ford trading above $12.75? How far do we have on Ford? I've underlined it there for you. Hopefully you can see it. How long do we have for Ford to go above $12.75? All right. For some reason, I don't. There you go. March 16th. Perfect. We have until March. We got plenty of time for Ford to go above $12.75. Now, taking a quick look, obviously what we paid 47.44 cents for is only worth 14. Kind of sucks, right? Not a good position to be in. Hence, we gave ourselves way out to March. We gave ourselves time for Ford to go higher. We didn't just put it in that week. We didn't just put it in that month. We actually gave Ford about 2 full months to move higher. Nice day today on a stock market that's down a full 2% to see Ford higher by 10 cents. That's not a lot to speak of. It's not even a full 1%. Kind of shows us that Ford is a defensive stock. Ford is a stock that when the stock market sucks, it can give you a dividend. It can give you a special dividend of 25 cents. It can buck market trends. Ford right now is a nice defensive stock. Good position to have, good position to be in. Visa. We've got 500 shares of Visa. We were looking so good until today because Visa fell $4.03. We're probably going to get most of our credit of $1.19. But take a look. We're only making 32.5 cents on our short call. Please do not ever think a short call is protection on a stock. We only took in $1.19 on a $73, $74 stock. That's only 2%. We still have 98% of the risk in the stock, even though we have a covered call. A covered call is never protection on a stock. It might give you just a little bit of time to think about your next play. The good news is we're going to collect most likely $1.19. In fact, we might be able to roll that down a little bit and collect a little more credit. We'll have to work all of our numbers. I will need to bring you guys up to speed, but I'm on our trades. But let's go through really quickly the psychology of trading. I think it's I think this is interesting. This is Jeff. This is more up your alley. Keith, it might be up your alley too. But market psychology is defined as nothing more than the overall sentiment or feeling that the market is experiencing at any given time. What's the market sentiment right now today? What is the market sentiment right now today? What would you call it? Jeff, we are going to Evan, we need to have a patent out for a couple comments Jeff has made today. He calls the market craptastic. So, Jeff, we need to patent that word so we can start to use it regularly in the stock market. Could you imagine CNBC saying, we've got another craptastic day in our stock market? Love it. Yes, greed, fear, expectations, circumstances are all factors that contribute to the group's overall investing mentality or sentiment, which today is craptastic. If you don't mind, I'm going to borrow that word, Jeff, on Wednesday. Wednesday, I've got a couple groups that I do a chat session to. I'm a little fearful of going over something big like CNBC, but I am going to use that word. Breaking down, term of market psychology. While conventional financial theory describes the situations in which all the players in the market behave rationally, not accounting for the emotional aspect of the stock market, sometimes lead to unexpected outcomes that can't be predicted by simply looking at the fundamentals or a chart. The market is breaking down today. They had the better football team win yesterday. China, the whole China risk is off the table for a week as they're closed for their New Year's. We've got Japan that's going to go negative interest rates. All situations today defined as of last week, even through the futures last night, all said we should have a rebound today. But the market's breaking down. Any idea why the market's breaking down today? There are two reasons. Sorry, I'm getting more text from my wife. No car accidents today. I can't wait to have that conversation with Evan. All right, here we go. Sorry, guys. My wife was just texting me how gymnastics was and that there's no car accidents today and all that kind of good stuff. Okay, today, oil is down yet again. So when oil is down, the market worries. Also, the other comment on today's stock market and why it's down is an uncertainty of global growth, which there's always an uncertainty of global growth. But the market is breaking down today because oil is down, and I don't think it's down significantly. I'm going to take a quick look here, although it's probably down below 30. So there you go. Oil's down. Brent's still at 33.59. Oil, which is West Texas for us, is down 72 cents, still above 30 at 17. So the reality is that today we're just seeing a knee-jerk reaction on the fact that oil is down. Well, you know what? That's kind of interesting. Oil is down. There's obviously a fear of a slow growth, but something that I wasn't factoring in. We had some GDP last week on Thursday, I believe. Some GDP, not GDP. We had politicians do a debate, and you know what? They all suck. No one seemed to like anyone. So maybe the United States today is also subconsciously taking a beating for the fact that our future, at least by way of our presidential candidates, no one likes anyone. Not a good position to be in. Don't forget technical analysis to use trends, patterns, and other indicators as to assess the market's current psychology state in order to predict whether the market's heading upward, which is bullish, or downward, which is bearish. Definition of investment philosophy, a little bit different here. Investing versus trading. Investing is a set of guide principles that inform and shape the individual investment decision-making process. Examples of investment philosophies or styles include value investing, fundamental investing, growth investing, social responsible investing, technical investing, contrarian investing. The reality is, whatever you define yourself as, you've got a set of guiding principles. In our case, it's the collar trade. They should have in here, I know I don't know at investing. That's what we are. We're not so prideful that we think we got the market figured out. We're the I know I don't know it all investing, where we're going to protect ourselves to the downside. So in a stock market like we're in today, I'll be honest, with today's loss, our stock market has to be down 14% overall on the S&P 500, 17 on the NASDAQ. If it's 12, it's 11 for the Dow. We're down about probably 5 in that time period. So we're making up about 60%-ish of the downward movement right now. Market psychology. Overall sentiment and feeling that the market's experiencing at any given time. This is controlled by greed, fear, expectation, circumstances. This is a great example of market psychology today is being pretty poor. Market psychology today is that, hey, we're in a low growth global environment. Definition of investment psychology. A set of guiding principles that form and shape an individual's investment decision-making process. What makes a good trader? One that can control their emotions. How do you control your emotions? By having your plan in place. Discipline enough to follow your plan. When the market sucks like it does, stick to your plan. Systematic approach. Don't just randomly have things put on you. Wait for those technical crossovers. A mentor. Hopefully that's going to obviously be myself and Jeffrey. Profit. That you make money. A good trader cannot be someone that's losing money. A good trader has to be one that has to make money. Now the part is you need to define that time period. A good trader usually is one that makes money over a year's time period. How do we control those emotions of greed, fear, and definitely panic in a newly defined craptastic market that we're in? To control that greed, obviously, you need to get excited about your profits, but you can't be unrealistic. That's where technical analysis gives you a general idea of where a stock is going to go. A profit's a profit. You never hurt yourself taking profits. Can you sometimes make more? Of course you can. But don't forget, hogs get slaughtered. Fear. If your trade is scary to you, if you don't understand it, you're not comfortable with it, you should not be getting into the trade. Jeff made a comment earlier today. Man, I don't think 3-to-1's all that good. Bingo. There's your first red flag. You don't get in the trade. Another great part of controlling fear, virtual trade until you have it down. Paper trade your guts out. Learn without losing money. In fact, if I can be so kind, I had a very interesting conversation with someone, and she was very polite, and she's doing a fabulous job studying and learning the education. But her comment was, you know what? I want to get in and start making money. And inside of me, I thought, what are you talking about? And I had to take a step back and remember where I was at that point. The reality is, if you're going to be an engineer and you want to go out and you want to build a bridge, you don't take one class in engineering that teaches you how to build an A-frame and go build a bridge. Right now, you guys are in your least experienced, most uneducated point in trading. Don't risk your nest egg. Go ahead and paper trade where it doesn't cost you anything. Panic. Don't do it. Whether it's up or down. If you're panicking on the stock market, you're not in the right frame of mind to be making a trade. Find ways to learn from your mistakes. Discipline. Nothing more than knowing what you're going to do and when you're going to do it. A lot of times you're going to hear us talk after we go through levels 3 and 4, especially when we go through those basic trades. We're going to talk to you about not over adjusting. That's where we get into don't try to get too creative too often. Keep it simple, stupid. The easiest way to not lose money is to keep your discipline simple. Don't get too attached to a stock or trade strategy. Collar trades are obviously one exception, but what we mean by that is just because you love GoPro and it's fun to tape your kids crashing going down the mountain skiing or so forth, doesn't mean you have to own GoPro stock. GoPro stock's fundamentals tell you don't own GoPro. GoPro is down 2/3 from where it IPO'd, where it entered the market act. And act when it is time to act. Again, that's usually technical crossovers. You're going to develop some systematic approaches to the stock market. Those are habits. Obviously, you need to be able to create habits and schedules you can follow. If you're working during the day, you can't have a full-time job and be trading in the stock market unless you create a habit like a collar trade that helps to be realistic with the time that you have, where you place your trades before the market opens, where you can tweak your style in that collar trade. Hey, I'm going to let my stock run for a while because it's bullish. Hey, I'm going to overprotect it to the downside because it's bearish. Our stock market's craptastic. I want extra protection on the way down. There are a lot of things you can do. Obviously, the mentor should be someone you can trust, someone with a track record, someone that you can see and talk to, someone that hasn't floated you an idea or concept that sounds too good to be true. This is obviously someone that you want to make sure is going to back you up what they are telling you. Obviously, I consider myself in that position. And obviously, last but not least, profits are profits. Don't care about winning or losing percentages. Your only concern is how are you going to grow your portfolio. I love this example where we see people talking about a 90% plus winning trade record, but their net after they're done with those 10 trades is that their portfolio is down $495 or a 10% loss. I would much rather learn how to adjust, take a 0% loss. I want to capture and or protect my profits. Guys, in summary, Good traders often stay disciplined to what they know works. That's the collar trade. It's a process. It occurs over a period of time. They follow the advice of successful traders they trust. They never let their emotions get too high or too low, but they appropriately celebrate their successes and learn from their failures. Guys, I'm going to get both of these recorded for you. And, well, I'm going to get all of this recorded for you and online. Any questions that you have right now that I can answer for you? If not, Wednesday evenings at 5 p.m. Mountain Standard Time, I've got a chat session where it's more general, where I go over live trades. You can access that in the chats part of your safe option strategies. And I guess we're going to go from there. I don't see anything coming in. So at this time, guys, have a great craptastic week. Keeve, congratulations on having the Denver Broncos win. I was going to show you something. You know, you guys have heard me say I'm a Raiders fan, and I am. I love the Raiders. I know you're probably going, Kevin, out of all the teams in the world, that is about the worst. But just so you know, I do have a couple friends in high places, one or two, and it was really interesting. I got to spend a little bit of time for the Wounded Warrior Project last year, and I, got to meet some great people. Let my computer catch up here. I'm going to show you a quick picture of a friend of mine, and now he's a Super Bowl champion. Pretty cool to have met and spent some time with Malik Jackson last year. And there's Malik Jackson. See if I can't save it and bring it up a little bit differently. What a big guy. He doesn't look that big compared to me because I'm also obviously a bigger than average guy. But pretty cool to have a night hanging out with Malik Jackson. He's a pretty amazing person, not to mention he's a USC guy. So obviously a bit of fun, but nice to see Malik get a Super Bowl win. Amazing guy, does a lot of charity as well. All right, guys. Hey, I will talk to you later. Look for an email that'll have today's class is recorded, and I look forward to seeing you guys next week.